Of Biz Talk, looking ahead 2023. Today we focus on supply chain and foreign investment in China, also some key issues in the Chinese economy. In the past 3 years, China's pandemic control maintained its manufacturing powers, stabilized global supply chain and helped world economy recovery. Since early December, China eased COVID restrictions, and on January the 8th, the country reopened borders to encourage the recovery of international travel. The moves are widely welcomed by global banks, who quickly revised up China's economic growth forecast for 2023 to between 5 to even 6%. At the same time, some international observers worry that the rise of COVID infections in China may disrupt its manufacturing and global supply chain and influence foreign companies' operations. Some others worry that China's opening up may push up international inflation. But what's the real story? What's the real situation? We are joined by three distinguished guests today. We welcome Mr. Dennis Depaul, Global Managing Director of Roland Berger. Welcome, Dennis. Dennis joins us from Paris. We welcome Dari Guppy, former Director of Australian-China Business Council and CEO of Guppy Traders. Hello, Dario. And we're also joined by Professor Yang Hengjun. He is Associate Dean of the School of International Trade and Economics, UIB, University of International Business and Economics from Beijing. Thank you for joining us, gentlemen. And I'm Junfeng, the host of CGTN's Global Business. Well, first, let's talk about the overall economy and supply chain. Dennis, this question is for you. Global banks quickly revised up China's economic growth forecast of 2023 to between 5 to 6%. And that's after China eased its COVID restrictions and opened border. What's your prediction of China GDP growth for 2023?
Thank you for that question. That's a difficult one, and I don't have a crystal ball. There's indeed quite an array of forecasts for 23 or even for 24. I think for 24, I've seen figures up to 11 or 12% in some of the forecasts forecasting a rebound. There is a consensus on the rebound, and indeed, I think the COVID wave in China is strong, but it's also quite fast. And we can imagine that, let's say, by the end of February, most of the countries will have been through this at least first wave, and therefore recovery is down the road. So consensus on rebound, consensus on a pretty strong recovery, both on the manufacturing and production side, with everything going back to normal, and also on the consumption side. So that, I think, there's no doubt about that. But still, that would leave the year with probably 10 out of 12 months or 9 out of 12 months normal. And there's also consensus that higher growth than in the Eurozone or in the US should be experienced by China. So whether this leads to 5, 6%, I don't know. I'm always very skeptical also with these figures, because that reflects very different reality from different regions in China. So I'm not sure that the overall figure is so meaningful. We've had this very large wave of COVID now in big cities, but that's going to move to the rest of the country down the road, probably with less economic disruption. Another factor is the impact of exports, because we have slowing demand in the world because of the looming recession. And as we know, exports is maybe 20%, 21% of China's GDP. So when this slows down, that also has an impact, which is not related to whatever was going on. So how this play together? Yeah, I'm quite skeptical to dare to say a figure.
Right. What about the supply chain? What role do you think China plays in the global supply chain, and how will China's reopening up influence the supply chain?
Well, I mean, China is, and will remain the factory of the world. So what we've seen through these last few years is pretty extraordinary resilience of the Chinese supply chain. If you think about it, I mean, it's not only about COVID. It started with the trade war with the US, the imposition of tariffs, And through this whole process since 2018, the Chinese supply chain has been resisting very, very well. Actually, if you look at the second half of 2020 or the full year 21, the Chinese supply chain has helped absorb the surge in demand post-COVID in Europe, post-COVID in the US, by exporting more. The export figure in China is up 30%, 21 versus 2020, or actually versus 2019, pretty much the same figure. So it's massive progress of the export capacity of China, and it's not only volume; it's a lot of investment also in manufacturing capacity. So of course, after COVID, after all the logistics bottlenecks, after the war in Ukraine or during the war in Ukraine, corporates are thinking of diversifying their supply chain, going to shorter circuits. So there are a number of changes. There are also fundamental changes due to the cost position of various countries, and that includes China. There's also China positioning on higher added value, so meaning that other things go somewhere else. So there are changes, obviously, but the depth of the Chinese supply chain is such, the agility, the ability to pick up volatility in demand is pretty much unmatched. And therefore, I think we'll soon forget about what has happened in the last 3 years. And yeah, China might lose some market share in some fields and will gain market share in other fields. So I would not be very concerned about the role of China in the global supply chain going forward.
Thank you so much. You raised consensus of a strong, fast growth in China, and the world will have the thinking that China will remain the factory of the world, and the world will soon forget the past 3 years and move on. Professor Yang Jun, you recently wrote an article saying about the significance of China's supply chain in the world, and it helped world recovery. How so exactly? What the key message in your article?
Yeah, so thank you for the question. Yes, I wrote a short article about 1 week ago. So I think first of all, I need to point out, China has tried its best to combat with the COVID and has made important contributions to the global fight against COVID. So let's see a set of data, right? During the past 3 years, China has provided more than 2.2 billion doses of COVID vaccine to over 120 countries and international organizations. It also has provided massive amounts of pandemic supplies to more than 150 countries and 15 international organizations, and dispatched expert medical teams to 34 countries. Right? So now in 2020, when the world suffered, I think, most from COVID, China took the global lead in resuming production by implementing strict COVID measures and developing a set of effective methods to resume production. So that helped, I think, make China the most stable and reliable production base for the world at that time. So the year 2020 saw China's economy expand 2.2% during the worst part of the global pandemic. So that made it the only major economy achieved with positive growth that year, right, which provided a significant contribution to stabilize the global supply chain and help the world economic recovery. And China has continuously modified its COVID policy in order to achieve a good balance between COVID response, like prevention, and the economic development. So in 2021, China's economic growth reached 8.1%, far ahead of other major economies. So moreover, China's total imports and exports of goods grew 21% in 2021. And the latest data from China's customs show that China's total export and import of goods grew about 7.7% in 2022, so exceeding a record 42 trillion a year, which is equivalent to about 6.3 trillion US dollars. So I think as the world's factory, China continuously to steadily deliver cost-effective products internationally and help maintain the stability of the global supply chain, and as to help the recovery of the world economy.
And how would China's recent reopening influence global supply chain? And as some worry, would it affect global inflation?
So I think, as you know, China eased, right, the COVID restrictions and opened its border on January 8th this year. So I think, as expected, there's a large wave of infections across the country following the relaxation of COVID restrictions. However, the virus, I think, the spread much faster than expected, which caused a lot of trouble in the short term, especially in the second half of December and last year and early January this year. Now the situation is getting much better. So people's lives and business operations are gradually returning to normal. So and in less about 1 week, we'll have the Chinese New Year.
Yeah.
So almost all the manufacturers in China will suspend production for about 1 or 2 weeks. Right? So in the short term, the manufacturing and the supply chains in China will be affected by the quick rise in COVID cases and the coming Spring Festival. And however, I think starting from probably like February or March, China's manufacturing and the supply chains will gradually return to normal. Of course, I think it will take time to recover to the pre-pandemic level.
Great. So we're just talking about weeks of suspension, weeks of little disruption in manufacturing. Right. And Dario, what's your opinion on China's reopening's influence in the supply chain domestically and globally?
I think the reality is very different to what's often perceived in the West. There is this idea in the West that somehow China stood still during the COVID period and that there was no development. There was a suspension of activity. Now, this isn't correct. As we've already heard from Dennis and Zheng, China's economy continued to expand. Exports were still taking place. Yes, there was supply chain disruption, but that was also due to a range of external international factors as well, such as the pile-up of containers in San Francisco and Los Angeles, for instance. So what we're likely to see is short-term strains. It's going to take time to recover, particularly from the nearshoring shift that took place, but the appeal of China's supply chains is simply irresistible and irrefutable. They will come back strongly. Now, it will take some time to restore trust in supply chain security, and that's going to become an important factor. We've had a turn away from supply chain dependence that's going to continue for some time. So we're not going to see a return to the pre-COVID period, but we're not going to see a diminishing in China's role in supply chains and its importance. Now, COVID has really showed that China and China's supply chains really cannot be replaced. They are essentially irreplaceable. So we'll move back into that situation. Low labour costs certainly accelerated the shift to Vietnam, Laos, other countries of lower labour costs, but that's part of the development, the economic development of China, where there's a move away from low-cost production to higher value-added production, and increased wages are an important part of that. If you don't pay people, then you can't drive the consumer recovery. The Xi Jinping's talk about a circular economy, this is part of what it relies on. So the result is that we're going to see continued higher-end industry development in China. The things we have to worry about is that we cannot ignore the impact of US tariffs on supply chain demand. We also need to recognise that inflationary impacts are no longer driven by commodity impacts. We talk about the price of oil. The price of oil peaked 6 months ago. It's now trading back at levels that we haven't seen for 3 years. So the idea that we're talking about commodity-induced inflation probably is not correct. What we can talk about is a degree of US debt and free money that lies in the US that's helping to drive that inflationary spiral.
Yeah, Dario, you talk from a very broad perspective. I like what you said about the short-term strain in supply chain, but China's supply chain is still, I quote you, irresistible and irrefutable. It's very interesting you use these two words. And you talk about US impacts, but it's another topic. Let's focus on commodity prices because you touched on that. But we do see copper and oil prices tip up a little bit in recent weeks. And how would you address the Western media's worries about inflation pressure that could caused by China's consumption resumption?
China's return to consumption is not going to be inflationary in and of itself. Those inflationary drivers, I would suggest, are not driven by commodity demand. They're not driven by the situation in Ukraine. These were purely short-term impacts that were relevant in the first half of 2022. They are no longer relevant going forward. What we're looking at is the application of correct fiscal and monetary policy to be able to control inflation. The danger is that the remedies that are being imposed, particularly by the United States, are not suitable for supply-driven inflation. They're more suitable for demand-driven inflation.
That's very well put. Thank you so much. Professor Yang, because you have a lot of studies on supply chains, let's talk about the key components of supply chains. It seems that commodities, as Dario put up, in a healthy and stable manner, driven by demand. Labor force, stable in China. People get back to work. Power infrastructure, stable in China, not much change. Manufacturing, all stable. Logistics going on smoothly. We saw all these deliveries on time. All these elements are stable, so we are probably going to see a good year for supply chains in China. But what could go wrong? What could be some potential challenges, Professor Yang?
Yeah, so yes, I agree. No, the overall picture for China's supply chains look good like this year. Definitely will be much better than 2022, like last year. So I think, however, there are still some potential challenges ahead. Now, first, I think the pandemic itself remains at a high level globally, and the virus continues to mutate. So there's still uncertainty about the pandemic, which certainly will affect the key components of the supply chain, such as labor, manufacturing, and the logistics, right? The second, I think for a supply chain to run smoothly, besides the supply side, like manufacturing, labor, supplies, and the logistics, the delivery, like transportation, we also need the demand side. Now, if the demand was reduced significantly, no matter domestic demand or foreign demand, then it would greatly affect the supply chain. So with the easing of COVID restrictions, the domestic demand will likely to be strong this year. However, the global demand is projected to be weak, so which will affect China's exports and the related supply chains. The third, the global supply chain shows a trend of decentralized or regionalized production. So many countries started nearshore outsourcing or friendly shore outsourcing strategies. Some countries, especially by US, started to promote so-called China Plus One strategy. That is, foreign companies, they only produce in China and export to other countries, need to find a second production base, so which will certainly affect China's supply chains.
Good points. And that leads me to the question for Dennis. Professor Yang just mentioned the probably challenges for China's supply chains for 2023. One of them is demand that could have some, possible turbulence. Do you think after China's reopening, China's consumption will automatically come back, or would there be some measures needed, Dennis?
I think a stimulus, which is a typical response, cannot harm as a kicker to probably accelerate things. But I think there is I would not say there is automatic recovery once the COVID wave sort of settles down, as said by Professor Yang, probably pretty quickly, because there is a bit of a shock, anxiety, uncertainty looming, and that's at home in China. That's also abroad. I mean, I am outside of China these days. Anxiety and uncertainty is also an important factor. So I don't think it's only about stimulus. It's also about confidence in the future. Consumption requires confidence in the future, requires disposable income that is used to consume as opposed to saving. And that requires, I think, not only stimulus, but also structural reform. So the question is, how do you unleash this consumption? And by the way, this is not a new topic for China. So it's particularly important probably this year, next year, to restart the machine very, very strongly. But that issue was already there before. So I think there are two responses. One is common prosperity. I think a lot of people comment about common prosperity, saying, okay, it's about making the wealthier a bit less wealthy and redistributing. Well, there might be an element of this, but it's not material, at least so far. It's more about increasing the middle class by its bottom, actually. So not by the top, but by its bottom. And there's a lot of potential, obviously. Yeah. And I think we're seeing some efforts. We're seeing some pilots. I think in Zhejiang province, some pilots to try to turn the periphery of cities into actually suburbs, and to lift up the income, and therefore the disposable income. Mm-hmm. That has an effect on consumption. It's not coming overnight. It's structural reform. Another example is the pension system. I think in November or late November has been announced the launch of the private pension system. That's an opportunity to funnel the savings in a way that makes sense for the economy, as opposed to people keeping their savings, not investing in real estate lately, as we know, given the crisis in that sector. So how do you unleash consumption? Well, you unleash consumption by making people trust in the future and make their disposable income available for consumption. And therefore, I think it's not only about a kicker, which cannot harm, but it's also about that structural reform.
I'm surprised at your insights into the Chinese economy. You talk about the common prosperity notion, and also the structural reform and the pension system. Great insights, Dennis. Just like Professor Yang just mentioned, I want to ask you a second question. You said about the challenges for 2023 include the pandemic wave, because according to international experience, the large number of infections could probably come back every 6 months. It happens in many economies, many countries around the world. Similar situation in Japan, in Europe, in America. So this would relate to your previously mentioned anxiety in the consumption group. So how do you think this could play in the consumption market in China? Because this is not stoppable. This is like a natural thing, right?
Absolutely. I would believe that people will get used to it, as Europeans, Americans, everywhere in the world, Southeast Asia. Been traveling a lot after spending quite some time in China, obviously in the last 3 years. And my observation is that it's not that people forgot about COVID. I think it's there. Some people wear masks, some people don't. But generally speaking, I think the influence of wave after wave is quite limited on the economy. People have simply integrated this. So in a way, it's already in the figures. If I would put it in a very analytical way, it's already in the figures. So indeed, people get sick, people disappear for a few days, sometimes because of an infection, but they then reappear, and everything is hopefully fine. So I would not expect something very different in China. And as we have seen a very accelerated wave lately, I would say that also the way the future COVID waves in China influence the economy and influence consumption will also learn from what has happened in the rest of the world, and therefore have limited impact. So I would definitely not say that this has no impact, and prevention still needs to remain, and maybe in some cases also harsher measures, as we have seen in Europe, as we have seen in America from time to time. But on the impact, I would say limited going forward.
Right, so people will get used to it. That's the experience, the major experience. Great. Dennis, let me continue to ask you this. Foreign direct investment into China grew by 9.9%, roughly 10% in year 2022. So it means that China keeps attracting foreign investment. Why has China been attractive to foreign direct investment even during the most difficult time in 2022?
Well, I think China is, as I said before, a very attractive supply base. It's attractive by its size, its depth, its industrial cluster. So it's not only having one supplier, it's a string of suppliers. It's well established. It can absorb swings in volatility. And that's true in manufacturing, but that's true also in heavy industry, in production. So in process industries, let's say glass, chemicals, sort of base chemical, but also fine chemicals, etc. So this is still very attractive. What you see in 22 in terms of foreign direct investment is also the result of decisions that were made in 2020 and 2021. And as I said before, China absorbed a lot of demand that could not be met by COVID crippled manufacturing bases in the US or in Europe in late 2020 or during most of the course of 2021. So these decisions were made at this point. And I think if you take the chemical industry, this has played very nicely because there was a lot of demand and there's still a lot of demand domestically here in China, but also the chemical supply base in China serves the rest of the world, and particularly serves Europe these days when energy prices make it a lot more attractive to produce some of the energy-intensive chemicals elsewhere than in Europe. So we've seen ammonia export of China surge. We've seen glass exports of China surge as well, just to take two, let's say, basic product, but also much needed elsewhere in the world. And so that's why investment is attractive. Now, let's also face it, we might see a bit of a glitch going forward, because I doubt that there's much investment decisions by foreign companies in China made in 2022 in the midst of the uncertainties that was reigning during the year. And that's a normal thing. So foreign direct investment is up and down. One last point. If you look at the structure of this foreign investment in China, and that's not new, that's already for the last 4 or 5 years, it's very concentrated. So it's concentrated on very large companies, so the automotive giants, the chemical giants, the electrical appliances giants. So that's the first observation, and these companies have a very broad reasoning around their footprint and their supply chain. So point one, and point two, it's also quite concentrated in terms of the countries of origin. So it's a lot of Korea, and then it's a lot of European companies. So it's Korea, Japan, then Germany, UK. So it's quite concentrated, and therefore, I mean, there's a lot of trust. It's the large companies of these countries basically investing in China to improve their footprint and also to play a regional play. So also integrating the supply chain in Asia to serve China, but to also serve the rest of Asia.
Thank you for your insights into this. You mentioned that these important investment decisions are made normally 1 or 2 years prior to the actual investment, and it's always up and down. And all these concentrated large international multinational companies have broad visions investing in China from East Asia, from Europe and North America. So, but there are always talks in Western media about decoupling from China. Do you think any of these major investors or multinational companies would do such a thing, decoupling from China?
Well, I don't think that there is such a thing like massive decoupling of China, just for all the reasons the three of us stated before about the resilience and the quality of the Chinese supply chain. But there is diversification. There is also fundamental changes. I think Professor Zheng was, and Daryl also were talking about the shift of, let's say, low added value industries into Vietnam. I was in Vietnam in December. It's quite interesting. Vietnam is welcoming those investments, but they also see the risk that they turn into a very low cost supply base and they cannot modernize their industry and their production facilities. So there is concerns in the Vietnamese government that this shift from China is a good and also a bad thing in the same time. On the Chinese side, there's a huge modernization drive. I think one of the things that most people have not seen is that there's a lot of fixed asset investment. I think it's 40% of the fixed asset investment in China in 2021 that went to production and manufacturing. And out of this, more than 1/3 is dedicated to modernization. So it's robots, it's automation, digitization. That's double the size of the modernization investment the years before. And so that's part of the plan. That's one of the mottos of the 14th Five-Year Plan. So you can expect that companies follow, both state-owned but also the private companies. But that's also a lot of additional productivity in the Chinese system. So yeah, there is a certain level of decoupling. I think the US bans and restrictions on technologies are taking a big toll on the Chinese manufacturing system, and that will drive some diversification because simply things will become more difficult. But there are so many other areas where this investment can take place. Therefore, and China has an edge in multiple industries, be it telco, be it the whole electric vehicle value chain from batteries into charging stations through the whole vehicle value chain. So I would say, yeah, there is a certain level of decoupling or diversification happening. Part of it is just the normal course of thing and specialization across countries. Part of it is regional integration, by the way, driven by Chinese companies themselves that offshore some of their production to Southeast Asia to simply benefit from cost advantages, or also sometimes to go around some of the restrictions, and that's expected. And then there are some industries where China obviously has leapfrogged other players, and therefore that will drive also quite a lot of investment for the benefit of the rest of the world.
Great insights, great insights. Dario, I want to ask you, you served the Australian Chamber Business Council. What's the mood of Australian companies either in Australia or already those operating in China about the prospects of the Chinese economy and supply chain?
Well, of course, Australia is a unique situation because there's been a poor relationship for a number of years. Excuse me, so that's beginning to improve. So the mood is one of anticipation, but it's tinged with caution. So the task for business is first of all to restore businesses that were in place. Then the focus is on how do you expand that business, and finally on how we develop new business. Now, the important thing in terms of expanding and developing business is to recognize, as Dennis has talked about, that the economic structure of China has changed, that China industry has modernized, that China is far more advanced in terms of the digital economy than anything that is comparable in either Europe or the United States. So in fact, the West has a lot of catching up to do when it comes to the digital economy. So certainly Australian business is interested in exploring those activities. Now that's on the broader level, but there are some impediments that make it a little bit more difficult to take action. And the most important of those, and doesn't just affect Australia, but affects the entire APEC region, is that currently China is not recognizing electronic APEC cards, which means that business has to go through the process of visa applications, the physical visa applications and so on. So that's one of the impediments that's stopping this rapid re-engagement. It's a delicate reopening. There is room for error and misunderstanding, and that is not assisted in Australia in particular by a media that's not supportive of the Australia-China relationship and still continues to focus to a significant extent on the negative stories that they can generate about China. But the commodity development, the expansion of opportunities, the restoration of opportunities, that's what Australia's business is keenly anticipating.
Right. Thank you for your insights. And Professor Yang, on the attracting foreign companies side, China raised the concept of high standard opening up. What can be done better in China's environment to attract and keep foreign investors, Professor Yang?
Yeah, so I think when international investors make global investment decisions, a major consideration is the business environment of the country. So over the years, as Dennis mentioned, China has been one of the world's largest attraction for investment, which is a recognition of China's business environment. right? So I think in order to attract and keep foreign investors, first of all, China needs to continuously improve its business environment. So China actively benchmark itself against high standards of international economic and trade rules, like the CPTPP and so on and so forth, right? So steadily you can expand the opening of regulations or management standards and deepen reforms in some relevant domestic fields and create a market-oriented and first-class business environment to attract more and better quality investment from foreign investors. The second, I think China can need to expand foreign investment access and improve the level of foreign investment facilitation. And we can focus on the service industry, in particular, increase the opening up of the modern service industry, highlight the high-end manufacturing, scientific and technology innovation, and the green and low carbon orientation. Right? And we also can give full play of the role of the free trade zones or free trade ports in the expansion of opening up. We also can actively explore the opening of digital economy and other frontier areas. And the last but not least, I think the government departments at all levels should take the initiative to organize or implement international investment activities in various ways to provide convenience for foreign investors, to provide better service for foreign investors to engage in trade and investment, to China.
Thank you, Professor Yang. Dennis, I think what Professor Yang offered was a perspective, was a message from the Chinese government that China is very willing to continue to attract foreign investors, which is demonstrated by this concept, high standard opening up. Dennis, you must have noticed this concept raised by the 20th National Congress of the CPC, which I had the honor to report late last year. Dennis, because you have very close contact with foreign companies, what do you think are the most needed measures that foreign companies would like to have from the Chinese government in issuing policies? Dennis?
Sure. I think there is, as Daryl was saying also earlier, especially regarding Australia, but that I would broaden this to the rest of the world. There is a short-term effort to restore confidence, because let's face it, in 22 has not been easy for anybody. That includes domestic companies, but also foreign companies. And as a result, there's been something quite new for foreign companies in China, which is uncertainty, unpredictability. That's not something you expect in a planned economy. And that was always one of the sweet spots of China for foreign companies. Highly predictable, reliable. So, I mean, you have issues, you have short-term issues, but generally the vision is clear, the direction is clear. Somehow in 22, simply because of COVID and the circumstances, this has been blurred and has created a bit of doubts and skepticism. So this can be improved. It goes along with setting the direction, communicating, hammering communication on the direction, and making sure that there is no turning back, and therefore that people can trust the direction. And I think that has started with the 20th Party Congress, but there's a lot more effort at central, but also provincial and municipal level to restore that confidence. Generally speaking, a lot has been done in the last few years in terms of removing equity caps, shortening the negative list. So basically activating very concrete levers to open a number of markets in financial services, in energy, also further opening in the automotive sector, which is obviously so important. So I think there are still a number of restrictions. So I think the expectation also in the medium term is that further restrictions are levied, and that market mechanisms, as much as possible, maybe not in some strategic, let's say, sectors of the economy, but for most things, market mechanisms are the prevailing signal, or the prevailing driver for making business in China. one important factor, I think, is also the role of state-owned enterprises. I think this is also quite often misunderstood from outside of China. The level of corporate and social responsibility, as we would call it from the West, that is embraced by these state-owned enterprises is underestimated. But yet, I think this should be quite separated from market mechanisms. So I think the roadmap is quite clear. And the fact that China is also modernizing and turning to more added value products is also a very strong signal for foreign investors and foreign companies that are bringing also these technologies that will make China successful. Think of the Siemens, Dassault system of this world, selling machine tools or selling automation systems, as an example.
Great. I think one factor that some foreign companies worry about China's economic stability for 2023 is the real estate debt. The Chinese government has issued 3 arrows to offer help in the financial area to rescue the real estate sector, to stabilize it. How do you think these companies can fare in 2023? What's the prospect of this whole sector stabilizing and not causing problems for the overall economy for China?
I think restructuring the real estate sector is walking on thin ice. So it's very delicate because on the one hand, you want the real estate sector to be a bit more active and to go back to normal, but you also want to avoid, in the same time, that it goes again in speculative mode. And it is a restructuring. So it's not going to happen overnight. First of all, because of the size of the debt, as you mentioned. So I mean, it has to be restructured. The industry has to consolidate. So some players will simply not make it and be consolidated by others. By the way, this is maybe new here. It's not new elsewhere. So the real estate sectors in many other economies, including US, including Europe, has been through that process of restructuring, reducing debt, changing business models also to go away from the very merchant speculative business model into a model where you buy, you build and sell homes for people to live in, and maybe a second one as an investment with long-term lease, and ownership is separated from let's say management of those facilities. So we've seen this before. So it has to happen in China as well. I think it's going to take a decade. So it's certainly a delicate process.
A decade.
I think, yeah, a decade of restructuring,
yeah.
but also probably good because in the meantime, the economy will not, the real estate sector will not collapse. It's going to be a very gradual resolution of those problems.
Good enough. And Mr. Yang, do you want to add up on something on these delicate property sector issue?
So I think as Dennis mentioned, I think the uncertainty about the policy or about the business environment is really important. And so I think thanks Dennis for pointing out this issue. So especially in like last year 2022, so there are a lot of uncertainties about the business environment. So that I think really put a lot of pressures on these foreign investors. So I think starting from this year, we already made the decision, right? We announced we reopened the borders, removed all the restrictions of the international travelers. So I think will give back about the confidence for all these foreign investors. So certainly they will help to attract the foreign investment. Yeah.
Great. Dario, let me go to your part, the financial parts. We noticed that in 2021 to 2022, a significant amount of dollar capital flew out of China, let's face it, back to the US due to the Fed's aggressive rate hikes. Actually, all the dollar assets flew from everywhere around the world back to the US. Where is that money now? Will they come back, or some of them come back to China?
Well, the important thing to remember is that money is immoral in the sense that capital always chases yield. As hikes slow down in the US, then other capital markets become attractive. Now, the US capital flows, they may be limited by the sanctions actions that the US is currently taking. That's the major concern going forward. Now, that means that we may see capital flows coming from Asia as they turn away from US debt instruments because of the political risk that's involved, because of the unsustainable levels of debt within the US. Now, when I talk about political risk, what I'm talking about there in particular is the use of sanctions to tie up capital, the weaponization of SWIFT transfer systems, the corruption of international trade, and that means international investment in many ways. We're talking there about whether capital will come back into the real estate industry and so on. I just do note that the Bloomberg index of the dollar-denominated junk bonds in China, they're the real estate junk bonds, they're brimming with developer debt, but currently they're up 6.5% this month and more than 32% in the past 3 months. That beats every other major bond market benchmark in the world. Do you think that capital is going to sit in America where they're getting much lower returns? No, risk capital will come back into China. It will be risk capital for a start, but as the markets stabilize, as China resumes its economic development, then capital will come back chasing those higher yields. And as Dennis pointed out, the political stability that China brings, it reduces the sovereign risk to that type of debt exposure into China.
Great, you mentioned political stability. I have some numbers here. China's A shares main index rose about 25% in the latest round of gains since October. The yuan value against the dollar has risen to 6.7, very high now, about 10% higher than before. And MSCI China index has been raised by Morgan Stanley by 13% forecast of 2023. So let's focus, which sector do you think foreign fund managers would be interested when they invest back their money from elsewhere in the world, specifically from the US to China? Which sectors would be interested?
We've certainly identified the green and low carbon economy, and there's a tremendous amount of interest both in the West and in the developments that China has taken place. I think that most of the key areas are going to be areas that are related to the digital economy and the impact that that has on banking and those companies that are enjoying higher levels of government support. Now, of course, there's the normal ones, which are consumer discretionary spending as the economy recovers. That includes things like tourism, development of new energy vehicles, supply chains, and actual innovation in those areas itself will be of particular interest, along with software, high tech that are spurred by reactions to sanctions. Now, we tend to think that the CHIPS Act is involved in closing down China, and that's certainly the intention. But the unintended impact of that is it spurs innovation within the China space. So that's going to attract capital, that's going to attract investor interest. And of course, following COVID, there will be an increase in the health areas. So there's a broad range of areas that are of interest to foreign business and to foreign investors.
Great to know that. And Dennis, what about you? What do you think China's reopening of its border will attract foreign, let's say, global industrial capital and global financial capital back to China?
I would name a few things. First of all, I've been driven by the fundamental priorities of the country. I see, like Daryl, everything related to decarbonization and the green economy as one driver for investment, and also something where maybe I see it from a European perspective because I'm European. A number of European companies have quite some advanced technologies or know-how to bring. It's not only about technology, it's also about process. I think it's when it comes to decarbonization, technology might have been there for a while. So it's more about the way you employ technology. So that's one. Totally fit with the 14th Five-Year Plan and the priorities of China. The second one is everything staple basically. So all the basic consumption needs as part of the recovery, and of course that's maybe a more difficult area for foreign companies. But I mean, you have the L'Oréal of this world, etc. So definitely I see a lot more also localization. And therefore investment in China in that field. Third one would be modernization of the Chinese economy. So everything around digitization, automation, as Daryl was putting it. And still, I think I would add two: healthcare. Obviously, maybe not always easy for foreign companies, but definitely something that will emerge a lot stronger than it was before from the last 2-3 years. And the last one is still the electric vehicle or electrification value chain, with a particular focus on vehicles, with of course very stiff competition from domestic players that are generally ahead, but still a very valid market.
Thanks, Dennis. And Professor Yang, previously Dario and Dennis talked about some of Chinese manufacturing capacity flowing out to maybe Southeast Asia, South Asia to seek lower labor costs. What's your take on this? And do you agree with them that most of these manufacturing capacity is about low value added, and it's about regional integration?
So yeah, as mentioned by Dennis and Daryl, so China's manufacturing sector, yes, is facing, I think, serious challenges from South Asia or Southeast Asia, such as India, Vietnam, Malaysia, and Thailand, etc. So I think China's rising labor and rental costs and the ongoing China-U.S. trade war are the main driving forces. So, but I want to emphasize that as a country's labor and rental costs rise, it is a normal and natural economic pattern for some manufacturing or supply chains to move out of the country, right? So I think Dennis mentioned Vietnam. So in my opinion, Vietnam's strength lie mainly in improved domestic and international environment and the low labor costs, right? So in terms of domestic environment, Vietnam is in the midst of an important historical reform process, with the government focusing on opening up, deregulation, marketization processes. Also, international perspective, Vietnam has made significant progress in opening up to the world since 2017 or 16. I have launched or joined CPTPP, RCEP, the European Vietnam FTA, and in addition, Vietnam is also a member of ASEAN, right? So all these provide a good environment for Vietnam to participate deeply in the global supply chain. So in the short term, yes, like Vietnam has many advantages. But however, I think in the long run, Vietnam's ability to challenge China's role as the world factory is still limited by its relatively small population and economic size. Right? I think from my perspective, maybe India is more challenging to China's role as the world factory. According to the United Nations, in April this year, India's population will overtake China to become the world's most populous country, right? So the IMF also predicts India's GDP in 2022 will surpass the UK, becoming the world's 5th largest economy, only after US, China, Japan, and Germany. So India's GDP is nearly about 10 times as the size of the Vietnam's. So I think that the large population and the market size also supports India's a strong R&D capability. And however, I think India also has its obvious shortcomings, such as poor infrastructure and inefficient administration. So nevertheless, I think India has high potential to compete with China on the manufacturing sector in the long run.
Right, there's a lot to talk about on that, but let's move on to China's exports. It's facing some challenges of weak global demands. Some argue that even after China reopened its borders, its exports will still face global weak demand headwinds. Do you agree with that?
Yeah, so I think though, to be fair, everything else being equal, the reopening will definitely ease the export challenges for Chinese firms. But I think because like with the removal of the restrictions on international passengers entering or leaving China, the company executives like Dennis and Daryl are able to enter and exit the country with ease. Right? As you know, face-to-face communication significantly facilitates business cooperations or negotiations and then the international trade. However, as Dennis and Daryl pointed out, I think the world is facing the kind of recession, and many institutions like World Bank predicted the economic growth will drop to only to 1.7%, like this year, right? So this actually is quite low. If you look at the data in past 30 years. Even for developed economies, the growth rate will be only about 0.5% this year. So that actually, I think, will put a lot of pressures on the global the demand, right? So I think the China's exports are facing and will continue to face challenges, right, of the global weak demand, and so I'm afraid the Chinese exporting and firms need to probably prepare for a harder year. But I want to say we do not need to have to be too pessimistic, because the world economy is not performing well. Chinese products may even become more popular because they are usually very cost effective. Right?
Thank you so much. We have about 3 minutes left. Daryl, 2 very quick questions for you, because you're the chartman. First, China's Asia market lost 15% in 2022. Some say they will regain the loss this year. What's your prediction?
They'll certainly regain the loss. You know that some people are talking about a 13% return. That's very, very reasonable. The market's gone up 10% since October, 13% as Morgan Stanley suggests. That takes us up to 3,600, which is the 2021 highs. But the market has created what we technically call a double bottom. And by projecting that price or that measurement upwards, that gives us an upside target of around 4,000. So we think that 4,000 is a reasonable target going forward into 2023.
Right. Very quick answer. Thank you. PE and VC firms, venture capitals in China have faced capital shortages. They were very cautious in investing the past 2 or even 3 years, facing a lot of problems because they were capital drained. When those money, you think, chasing yields coming back from overseas to China, do you think VC and PE would have a better time and more bold in investing?
Oh, certainly. The capital market reforms that are currently in place, they continue to drive these structural changes in capital flows into China and across China. Cross-border collaborations between China's stock exchanges, the number of others around the world via equity, technology and regulatory standards harmonization, all of these create a global channels for the flow of Chinese institutional and retail capital into global projects. And this will be most obvious in the expansion of BRI-related, Belt and Road Initiative-related opportunities going forward into 2023.
Okay, thank you. Thank you so much. That's our guest, Dennis DePaul, Global Managing Director of Roland Berger, Professor Yang Hangjun from UIB, and our chairman, Daryl Guppy. Thank you, gentlemen, for our discussion for the past 1 hour. Well, you just watched our discussion. We find out that the COVID infections in China only have a very few weeks of strains on its labor force, and large cities have already passed the peak of infections. Manufacturing and supply chains in China are totally intact. Everything, including production, labor, market, shipping, are in order right after the Chinese Lunar New Year holiday by the end of January or the beginning of February. Long-term prospects for China's manufacturing and supply chains are positive, and 2023 will certainly be a much better year for China's economy than 2022, projected by China's own economists, our guests, and global observers. Thank you for watching, and this is Looking Ahead 2023. I'm Junfeng. Thanks for watching again. See you soon.